Welcome everyone to Vested Interest. This is Shane backing in for another Stock Pick of the Day video. It is September 27th, and before we get in the video, if you could help me out, hit that subscribe button, hit the notification bell so you're notified whenever we post any new content. It really helps out a small YouTube channel like me to get the word out, to share stocks like this one that we're going to take a look at today, American Express. For dividend growth investors, if you are one, join me on this journey of financial freedom. Join the Vested Interest community. And give me a thumbs up if you find value in this video at any time. Trying to get to 1,000 subscribers and beyond. So help me get there by doing all those things. Again, it really helps out a small YouTube channel like me, and it doesn't cost you a thing except for the 1 second that it takes to do that. So appreciate you hitting that subscribe button and giving me a thumbs up. Let's jump right in. Take a look at American Express and see if it's presenting any value right now. So if you want to know more about this company, check them out at www.americanexpress.com. That is their homepage where I pulled this information from. That is www.americanexpress.com. That is their homepage. So they have been around since 1850. Since our earliest days, we've strived to find new ways to enrich our customers' lives, have their backs, and provide our special brand of service in ways both big and small, even as our business transformed from freight forwarding to travel cards to innovative digital products and services. One thing has remained constant: our unwavering commitment to earn our customers' loyalty for the long haul. That standard of excellence guides us today. We promise to understand, respect, and back our customers and help them and their personal journeys, because when our customers thrive, so do we. So really, their bread and butter is credit cards. That's what they offer. They are a financial company. They do offer some other things as well: traveler's insurance, traveler's checks. So if you are going on a trip, maybe to a foreign company or a foreign country, you might want to purchase traveler's checks. They're insured, so if you were to lose them, you could cancel them and get them reissued. Also, if you are in the market for a credit card, whether as an individual or a business, they offer credit cards and some financial services as well. So that's what they are. They're a financial company with products like that, similar to a MasterCard, Visa, with a little bit of a twist as far as coming from the travel and more travel-oriented side of that house. Now, the reason we are taking a look at them today, down 0.81%, so not a huge drop, but a drop nonetheless. This is one that's been on my list for a while, so I thought we would take a look at it. We are talking about American Express Company, ticker AXP, out of the financial sector. Closed out the day at $149.90, 52-week range as low as $130.65, as high as $182.15. So they are floating in between their 52-week low and their 52-week high. Personally, I would like them to drop back under 140s. That's where I would be interested in this one here. And this is on my list. I would love this to be one of the next companies that I invest in. It is a Warren Buffett company as well. He's been invested in this one for decades, so another one in his portfolio that he likes. Average volume 2.7 billion. Today's was 3.7. A lot of volatility, you can see, but overall a sell-off throughout the day. Market cap 110.395 billion, a beta of 1.19, so they are more volatile than the overall market. Again, you can see that volatility. Price to earnings PE ratio 15.23. Really, you'd want to look at price to book on this one, but not use a typical one that you use for a bank. Compare this to MasterCard or Visa and see where they stand. Pretty good rating on this one overall, but price to book is applicable, even though price to earnings here, $15.23, is relatively nice to see for most companies. EPS, earnings per share, very high, $9.84 per share. Earnings date is coming up October 20th. So look for that if you're interested in this one. Forward dividend is $2.40 paid out on the year. They are a quarterly payer. We will see what they pay out per quarter here in a little bit. And 1.59% dividend yield. Now, this is typically a little lower than what I'd like. I would really, again, that's part of the reason I'd like them to pull back more. I'd like it closer to 2%. That's just kind of the starting yield that I like to look for. I don't mind some lower payers in my, or lower yield in my portfolio if they are fast growing. So we'll see if that's the case here in a little bit. Ex-dividend date is July 6th. We're way past that. Looks like they just paid in August 10th. So if you were to buy them now, you would be in line. Since we're past this August 10th date, you would be in line for the next one. And I'm surprised. They should have another ex-dividend date coming up here soon. Now, let's look over here. Ex-dividend date, and the payout ratio is very low on this one, 22.76%. Now, I like to get into statistics, look at dividend yield theory. to do that, again, drop into statistics, go down to dividends and splits. We look at their 5-year dividend average, 1.32%. We compare that to their current 1.59%, or over here where it says forward annual dividend yield, 1.59%, same number. And since this number is higher than their 5-year average, it speaks to some potential undervaluation for this one. Doesn't give us much of a margin of safety, but a little bit here, at least according to dividend yield theory. Again, this one is potentially undervalued. Now, I like to get into financials and look at free cash flow. There's also a lot of great information in here. Balance sheet, income statement, is revenue growing, their assets over liabilities, are they buying back shares? We're going to look at free cash flow. We want growing free cash flow over time so that we can have growing dividends over time. Dividend growth investors, that's one of the things I focus on as a dividend growth investor. I want growing dividends, right? So free cash flow back to 2019, 11.9 billion. Big drop here in 2020, 4.1 billion. Another jump in that, that CV-19, right? The COVID stuff issue. So a lot of people weren't spending money or weren't traveling, weren't going out. So I can see why that would be the big drop there. Back up in 2021, 13.0. Even higher in 2022, sitting at 19.2 billion. And then to date, looks like they're about 14.7. So overall, from 2019 to current, looks like growing free cash flow. And a bonus, they are repurchasing their own stock. So 4.6 billion shares here, So even though 2019 there was a drop in 2020, it's not accounted for in the increase in repurchase of stocks. They actually bought back less. But again, COVID-19 in 2020, I can understand that. Now, 2021 was really a banner year. Not only did they increase free cash flow, but they really increased their buybacks here, right? 9.2 billion, a little less in 2022, but there you can see that reflection in the free cash flow. So again, very nice growth on their free cash flow. Very nice to see they are consistently year over year buying back their own shares, which is good for you as a shareholder. It means you own more of the company as a percentage, even if you don't buy more shares. So stockanalysis.com is another one that I like. What you saw on the previous page was Yahoo Finance. I always recommend more than one source, at least 2, if not 3, so that you can make sure the information you are getting is accurate. I am not affiliated with either source. These are just 2 that I like. You pick any 2 that you want. And they have 16 stock analysts on this. They call it a consensus hold. I would tend to agree with this, even though it is potentially showing some undervaluation. I will say if we are entering in recession, people tend to forego paying their credit. They might use their credit cards more, but they might not pay the bill. So you may have some people going into delinquencies on their credit card debt if they get into financial trouble, if they were to lose their job, if we're in a recession. I'm not going to pay my credit card bill versus paying my light bill, my mortgage, my car bill. Most people's cell phone will come before a credit card bill, right? Not much a credit card company can do except send you to collections. If you don't pay your credit card, it's not like they're going to turn your lights off or kick you out of your house, right? So this I would tend to agree with only because it looks like we may be entering into a recession. I would argue we've been in a recession since 2019 and only propped up by all the stimulus that was pumped into the market, but that's another video. So let's keep going here. They have a low estimate of $146. Which would be a 3.39% decrease from where it currently sits. Average estimate of $174.44. That would be a 15.43% increase from where it currently sits. And if it happened to hit their high of $203, that would be a 34.33% increase from where it currently sits. All the while, you could collect that 1.5% dividend yield that it currently is presenting. I like to look at statistics here as well, and there is a couple things I like to look at: return on equity, ROE, and return on invested capital. I like 10% or better for both of these, and the return on equity number smoking, 29.4%, almost 3 times high as what I like. Now, I'm a little disappointed to see that the return on equity is so high, but the return on invested capital is relatively low at 3.9%. So this is a mixed bag. Meets the 10% or better on the return on equity, does not for return on invested capital. I also like to look at earnings per share growth forecasted over the next 5 years. I like 5% or better. This is sitting at 8.05. And as a kicker, this is not one of my metrics, but I like to look at it anyway. It is whenever I do a deeper dive on a company, this is one of the things I look at. What is their forecasted revenue growth? What is their current revenue growth year over year? And this is forecasted at 9.05%. That's extremely high revenue growth for an established company, especially. Now let's look at the dividend. Again, we saw the payout ratio was low. I think it was in the 22.7 range on the Yahoo slide. This one out of stockanalysis.com is saying it's 24. We're going to call it around 23%. Either way, it's a very low payout ratio, down in the low 20s. If you wanted to call it mid 20s, that's fine too. But very high dividend growth, 17.89% dividend growth on this one. So even though it sports a low dividend yield, it has very high growth. So if you're looking for a dividend growth to add to your portfolio, this might be one to put on the watch list. Going back to July 2020, 43 cents, jumped it up April 7th, 2022 to 52 cents. Looks like, I'm sorry, did I miss one in 2021? They did not raise it up in 2021. So they had a pause there in 2021. Jumped it up to 52 cents April 7th, 2022. Jumped it up again in April 23 up to 60 cents. So over the last couple years, back to their dividend growth, 17%, very high dividend growth. Again, COVID-19, I can understand a lot of companies did pause their dividend growth over time. So that's not a huge red flag for me. It may be for some other people. Now, this is the Vested Interest Stock Screener. This is how I set up the videos. This is how I look at a company on a high level to see if I am interested at all in investing. If I am interested and it meets 5 of the 8 to be investable, or in this case 6 of 9 since it's a financial company, then I will do more of a deep dive, like I said, into revenue, into forecasted growth, into their debt over equity ratios. How does their balance sheet, what does their income statement look like? Are they buying back shares? All that information will come into play to let me know the financial stability of the company. I'll also do a discounted cash flow analysis to see what I should pay for the company as well. Well, that is it for this one. Let me know what you think of American Express. Is it in your wallet? It is in mine, along with a couple other credit cards as well. And let me just say, my wife and I only use our credit cards to pay for stuff that we're going to pay off at the end of the month. So I don't put anything on a credit card that I cannot pay off at the end of the month so that I don't have to pay any interest. So that for us, that's our groceries. We're going to buy those every month. That's our gas and some of our bills, right? We're going to pay our bills every month. So I use my credit card to pay those things, and then I pay it off the balance every month so that I get the either cash back or I get the points depending on which card I'm using. So that's what we do with our credit cards. Credit is not bad if you use it responsibly and pay it off at the end of every month. There are benefits to using a cashback card, for example. If you put everything you're going to pay on a monthly basis on a credit card anyway and can get 3% cash back, why would you not do that, right? You're going to pay your mortgage, you're going to pay your light bills, you're going to pay for your groceries, you're going to pay for your gas. If you can put those things on your credit card and get 3% back for paying the bills you are going to pay anyway, why wouldn't you do that? That's just a tip that I use myself to get a little bit of reprieve on my overall bills for the year. Well, this one's gone a little long, so we'll wrap it up here. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us here on the Vested Interest community. Join us on this journey to financial freedom. Hit that subscribe button. Hit the notification bell down below. It really does help me out. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a stock like American Express you'd like me to take a look at in a future video, drop it down below and I'll work into the rotation. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investing journey for educational and entertainment purposes. Investing involves risk and money. You should never invest any amount of comfortable losing. Always do your own research and invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.